Hello and welcome. I am Professor Meena Gupta. Today we will discuss problems facing India's balance of payments. Before we proceed, let us be clear about what we mean by balance of payments. Balance of payment is a record of the monetary transactions of a country with the rest of the world over a period. It reflects all payments made to other countries and all payments received from them. Balance of payment comprises current account, capital account and change in foreign exchange reserves. Under current account, transactions are classified into exports and imports of merchandise and invisibles. Main components of invisibles in India are software exports and remittances. Capital account includes external assistance, external commercial borrowings, foreign investments and NRI deposits. We are going to discuss balance of payment problems in India in three parts. 1. A brief review of India's balance of payments position before 1991 and events leading to the crisis of 1991. 2. Balance of payments after the reforms introduced in 1991. And 3. Recent crisis following global recession of 2008 and 9. Let us first look at India's balance of payments till 1991. From 1947 to 1956-57, India had surplus in its current account. Size of debt deficit stood at 0.5% of GDP during 1951-55. Subsequently, development of basic and capital goods industries led to large-scale imports of capital goods and merchandise imports. Trade deficits increased. Deficit also emerged in current account. The strains of Indo-China conflict of 1962, Indo-Pakistan War of 1965 and severe drought of 1965-66 triggered a balance of payment crisis. Low levels of foreign exchange reserves and burgeoning trade deficit led to devaluation of rupee by 36.5% in June 1966. Devaluation increased the competitiveness of India's exports. Exports increased, imports declined and trade deficit declined from $1,000 million in 1960-61 to $131 million in 1970-71. Receipts from invisibles also turned from deficit to surplus. Current account turned into a surplus in 1973-74. Surplus in India's current account was, however, short-lived. First oil stock occurred in October 1973. It led to sharp rise in international oil prices. But India was able to absorb this shock. Exports increased and imports of gold and oil declined. Invisible receipts grew sharply, stemming from workers' remittances from Middle East. Current account balance again turned into surplus in 1976-77 and 1977-78 and stood at 0.6% of GDP. Foreign exchange reserves became equivalent to 7 months' imports. India's balance of payment problem started from second oil shock in 1979. It led to sharp increase in the value of imports. Imports increased from $2 billion in 1970-71 to $15.8 billion in 80-81. Trade deficit was high. Gulf War also led to stoppage of remittances from Indian workers employed in Kuwait. Invisibles became low. Foreign exchange reserves, including gold, SDR, decreased from $7.4 billion in 1979-80 to $4.4 billion in 1981-82. In the first 3 decades after independence, current account deficit was mainly financed by external assistance. FDI was restricted and foreign investments were mainly confined to government. In the 1980s, traditional sources of official concessional flows dried up. India had to resort to more costly methods of financing deficit. Share of external commercial borrowings and NRI deposits in capital flows increased from 16.1% in 1980 to 39.9% in 1991. Short-term debt, which is more expensive and volatile, increased. With greater recourse to these debt-creating flows, debt servicing increased and financing of current account deficit became more sensitive to creditors' confidence. Gulf War of 1991 made situation worse. An unprecedented balance of payment crisis emerged in the first quarter of 1991-92. Exports shrank, remittances fell. For the first time in 40 years, earnings from invisibles became negative. Current account deficit reached 2.2% of GDP. Outflow of NRI deposits was also very substantial. Credit dried and there was a net outflow of investment income. By January 1991, foreign currency reserves had severely depleted to $1.2 billion. By June 1991, they fell below $1 billion. These were barely equivalent to 3 weeks of imports. India had an external debt of $83.3 billion, which was 60% of GDP. India's credit rating had gone down. India took emergency loans from IMF, pledging 67 tons of gold. Another 67 tons of gold was sold to Bank of England and Bank of Switzerland. Rupee was sharply devalued twice at the beginning of July 1991. A spate of reforms was instituted. A comprehensive program of structural reform was undertaken with emphasis on the external sector. Steps included changes in trade policies, exchange rate policies and industrial policies. Subsidies were reduced. This was the starting of liberalized trade regime called liberalization. Doors were opened to foreign investments. India moved to current account convertibility in August 1994. Emphasis was on capital account to achieve sustainable balance of payments. Impact of policy changes was reflected in lower current account deficit. Current account deficit declined from $9.7 billion in 1990-91 to $2.7 billion in 2000-2001. For the first time since 1991, the current account recorded surplus of $3.4, $6.3 and $14.1 billion in its account during 3 consecutive financial years from 2001-2 to 2004-5. Foreign exchange reserves increased from $5.8 billion in March 1991 and reached $310 billion by March 2008, and its coverage improved from 4.9 months of imports in 1992-93 to 14.2 months of imports by 2002-3. Main factor responsible for improvement in current account balance was improved revenue from invisibles. Trade balance continued to be in deficit throughout the period as imports exceeded exports. Even during the 3 years when current account had a surplus, there was a trade deficit ranging from $10.7 to $13.7 billion. Measures adopted in 1991 did result in increase in exports for some time. In 1991, exports earnings accounted for nearly 66% of imports. The figure shot up to 85% in 93-94. Economic Survey of 1994-95 ascribed this change to open market driven and liberalized economy facilitated by structural change. This euphoria was short-lived as the ratio soon dropped to 69.7% by 1997-98. Situation again improved and the ratio reached 83.4% in 2002-3. This again was a temporary phase, and exports as a percentage of imports fell back to 67% by 2005-6 and were as low as 60.6% in 2009-10. Sharp rise in oil prices in the first half of 2000-2001 resulted in increased deficit in balance of trade. Within the imports, the POL items continued to increase throughout. As exports increased from $18 billion in 1991 to $166 billion by 2007-8, imports increased faster from $28 to $258 billion during the period. As a result, trade deficit increased from $9 billion to $91 billion. As a percentage of GDP, while export increased from 5.8 to 13.5 during this period, imports as a percentage of GDP increased from 8.8 to 21%, resulting in increase in trade deficit from 3% to 7.4% of GDP from 1991 to 2007-8. India's balance of payments, which is built up of a large trade deficit, is being sustained by positive invisible inflows. A notable development in the performance of India's current accounts since reforms has been the growing contribution of invisibles. From a negative figure in 1990-91, net receipts from invisibles increased to $76 billion by 2007-8 and reached $111.6 billion by 2011-12. Main factor responsible for surplus in current account during 2001-2 to 2003-4 was income from invisibles, which increased from $9.8 billion in 2000-2001 to $27.8 billion by 2003-4. This was much larger than deficit on the trade account during the 3 years. Among the 3 components of invisibles, such as services, transfers and income, the largest surplus is generated by services, mainly software exports, followed by remittances. Data exhibits growing share of software services in India's current account balance. Software exports rose from 0.9% of GDP in 1999-2000 to 3.8% of GDP by 2008-9. The growth rate was steady and above 10% per annum during these years. Exports of software services were less than $1 billion during 90-91. The earnings from software services multiplied several times and increased to $37 billion by 2007-8 and $62 million by 2011-12. Private remittances increased from $2 billion in 90-91 to $24 billion in 2005-6 and $42 billion by 2007-8. As a percent of GDP, they rose from 2.7% in 1999-2000 to 3.8% of GDP by 2008-9. Thus, software exports and private remittances emerged as 2 main financing items for the current account, compensating to a large extent deficit in merchandise trade. Despite impressive positive earnings from invisibles, the current account balance, which had become surplus during 2001-2 to 2003-4, turned into deficit in following years and reached $15.7 billion by 2007-8. The widening deficit in India's current account was met to a large extent by surplus in capital account. External commercial borrowings, which is a debt-based flow, constituted 26.8% of capital flows in 1990-91. These increased to 50.6% by 2000-2001. NRI deposits, which were 37.1% of capital flows in 1995-96, also increased. The main item responsible for large capital inflows has been foreign investments, foreign direct investments (FDI) and foreign institutional investments (FIIs). and euro equities raised by Indian firms. Net foreign investments, which were less than $6 billion during 1990-91, increased to $43.3 billion in 2007-8. Total FDI inflows into India during 1991-92 were only $1.3 billion. There was gradual increase in inflows during 90s. Though inflow fluctuated during the first part of 2000, following years witnessed enormous increase in inflow touching $37.3 billion by 2007-8. Starting from a negligible figure, net inflow of FDI, which are nearly 35% of total capital flows, increased to $15.9 billion in 2007-8. Portfolio investment inflows, which to a large extent consist of FIIs, shot up from zero to a staggering figure of $233.8 billion in 2007-8. Net inflow on this count during the year was $27.4 billion, larger than FDI. Opening up the capital account to foreign direct investment and portfolio equity resulted in substantial addition to reserves from 2000 onwards. Beginning from a low level of $5.8 billion at end March 1991, India's foreign exchange reserves increased gradually to $314.6 billion by the end of May 2008. No doubt, increase in foreign exchange reserves saved the country from a crisis in balance of payments. However, we should not forget that increase in these reserves was not a consequence of improvement in current account balance, but of increase in borrowings and foreign investments. Former is a debt-based flow that leads to outflow on account of payment of interest and amortization. Latter is a non-debt creating inflow that leads to outflow in the form of royalties and dividends. Both impose burden on the economy with adverse effects on current account. FIIs are also highly volatile in nature and introduce uncertainty in the domestic market. Greater exposure of the economy to the rest of the world through liberalized trade and investment also made it more vulnerable. As the country became increasingly integrated into the world, it could not remain impervious to developments abroad. Under the impact of global financial crisis, India's balance of payment has again come under stress from 2008-2009. The uncertainty surrounding the global economy has resulted in higher current account deficit and declining capital inflows. A balance of payment crisis has again set in the economy, worst since 1991. The current account deficit has grown from $15.7 billion in 2007-8 to $28 billion in 2008-9 and is estimated to be $88 billion in 2012-13. It widened to 4.8% of GDP in 2012-13 after touching 4.2% in 2011-12 and 2.8% of GDP in 2010-11. Stress largely emanated from decline in India's merchandise exports and deceleration in growth of services exports. But trade deficit continued to dictate the overall trend of the current account. It stood at 10.2% of GDP in 2011-12 and 10.8% of GDP in 2012-13 as compared to 7.4% of GDP during 2010-11. Exports increased from 166 in 2007-8 to $189 billion in 2008-9 and further to $310 billion in 2011-12. Imports increased from 258 to 309 and then to $500 million during the same period. Increasing trade deficit from 91 to $120 billion in 2008-9 and then to $190 billion by 2011-12. Exports during April-December 2012 registered a decline of 5.5% over exports during the same period in 2011-12. Imports recorded a marginal decline of 0.7%. As a result of steeper decline in exports than imports, trade deficit has further increased. Over the years, current account had derived some relief from surplus generated by invisibles, particular software exports and private transfers. Global crisis adversely affected the net inflow of invisibles. These declined from more than 91 billion in 2008-9 to 80 and $85 billion respectively during 2009-10 and 2010-11. Invisibles rose in 2011-12 to more than $111 billion and net invisibles as percentage of GDP improved to 6% from 4.6% in 2010-11. But during first half of 2012-13, net surplus under invisibles again showed a decline as outflows on account of payments under invisibles increased considerably. In particular, payments on account of business services showed a sharp increase. Growth in invisibles receipts decelerated mainly due to lower growth in export of services. Growth rate of software exports declined from 38.3% in 2005-6 and 28.8% in 2007-8 to 6.2% in 2012-13 after increasing somewhere in between. Private transfers and investment income also declined. Investment income payments rose on account of rising external liabilities. Deficit on current account continued to be financed by large capital inflows, but capital account balance, which was as high as $106.6 billion in 2007-8, declined sharply to $7.4 billion in 2008-9. This was caused by decline in external commercial borrowings from 22.6 in 2008 to $7.9 billion in 2008-9. Portfolio investments witnessed net outflow of $14 billion instead of a net inflow of $27.4 billion during this period. Net accretion to reserves, which was as high as $92 billion in 2007-8, had declined enormously since then. As the capital account surplus fell short of financing current account deficit, India had to draw down its foreign currency assets by $20 billion during 2008-9. Capital account balance again increased and reached $68 billion in 2011-12. This was mainly contributed by increase in banking capital from negative figure in 2008-9 to $16 billion, increase in NRI deposits from $4 to $12 billion, and increase in net portfolio investments to $17 billion. But net FDI inflows to India declined in 2011-12. The total outflow of FDI from India was only $6 billion during 2005-6. Thereafter, FDI outflows increased significantly and reached $27 billion in 2011-12. Portfolio investment flows have also shown wide fluctuations. Outflow of FDI and massive withdrawals of foreign funds from the domestic economy are posing a big danger. Let us look at the challenges ahead. After the 2008 downfall of global economy, the vulnerability of India's external sector has increased. The widening of trade deficit to more than 10% of GDP and the current account deficit crossing 4% of GDP in 2011-12 and in the first half of 2012-13 are matters of concern. A sizable share of capital is in the nature of portfolio investment that could moderate or even reverse if investors switch to risk-off mode. According to the data given by the Reserve Bank of India, India's external debt stood at $390 billion as of March 2013. There is a surge in non-government debt and non-concessional private debt. Short-term external debt, which is highly volatile, has increased. About 45% of total external debt is maturing by the end of 2013-14. Countries' inability to repay the external debt may lead to a crisis situation and worsen our balance of payment sustainability in near future. Rupee has experienced unusually high volatility in the past few months. Rupee exchange rate touched an all-time low of 68.8 rupees per US dollar on 28 August 2013. Grim global economic outlook, along with high inflation, widening current account deficit and FII outflows have contributed to this fall. Improved capital flows in recent months, particularly FII flows, have dampened the downward pressure on the rupee. Volatility, however, remains high because of high share of FII flows in total capital flows and variation in such flows. Such volatility introduces uncertainty in the domestic market and impacts business confidence. Tightening of liquidity by US federal and political uncertainty in India is likely to further reduce FDIs and FII flows to India. Government has liberalized norms and increased interest rates in order to attract external borrowings. However, a problem caused by hot money flows cannot be solved by more hot money flows. A constant and increasing current account deficit financed by short-term capital inflows cannot be sustained in the long run. Solution lies in tackling the problem at the source. There are structural weaknesses with current account. Lasting solution to balance of payment problem lies in reducing deficit on current account. The room to increase exports in the short run is limited as they are dependent upon the recovery and growth of other countries. As increase in exports is constrained by global recession, solution to the problem lies in decreasing imports. Increase in imports is not only due to increase in prices. There has been quantitative increase in imports of gold and non-essential items. In a bid to reduce imports, government has increased custom duties on gold and some other non-essential items. This is not enough. There is need to put quantitative restrictions also on gold and non-essential imports. Appropriate exchange rate policies, monetary policies and fiscal policies are vital to ensure economic stability and growth. The bigger challenge is to reduce external sector vulnerability. Let us summarize the discussion. India has been having long-standing problem with its balance of payments. Current account has been in deficit throughout except for 3 years. Deficit in balance of trade caused by excessive increase in imports, unmatched by increase in exports, lies at the root of the problem. India's balance of payment, which reached a precarious position in 1991, improved considerably after the reforms. A notable feature of this turnaround has been the emerging role of invisibles in the balance of payment. Deficit in current account is being financed by large capital inflows comprising of external assistance, NRI deposits, external commercial borrowings and foreign investments that have led to an increase in foreign exchange reserves. Situation, however, has deteriorated after the global recession of 2008-9. The rupee is experiencing unusually high volatility. Prospects of another balance of payment crisis is looming large. This is all we have for you today. Goodbye.